Groceries being delivered to your front doorstep is not necessarily a new concept, but when I think about it, the first company that comes to mind is Instacart, which only launched in 2012 but is now worth over $17 billion. I would guess that if a company launched with a similar goal to Instacart but with a 16-year head start, that they would be a pretty big success. But some businesses are just a little bit ahead of their time, which was the case with the once $7 billion startup, Webvan. This is a bit of business. Webvan launched in 1996 by a man named Louis Borders. If his last name looks familiar, it's probably because he also co-founded the Borders bookstore. The premise of the company was pretty simple. It was to allow people to order their groceries online and have them delivered to their doorstep within a 30-minute time frame of their choosing. However, that's not quite an easy goal to achieve today, much less in 1996. The excitement behind Webvan and a ton of other internet-based companies in the late 1990s was extremely high. Investors were pretty much dumping their cash into any company with a .com suffix, oftentimes disregarding their revenue, product market fit, or the valuation of the company. It was the gold rush of the internet era, trying to capture people's transitions to the new life with the World Wide Web. And Webvan was definitely no exception. Overall, the company had nearly $800 million invested into it. $396 million of it coming from venture capitalists, including SoftBank, Sequoia, Goldman Sachs, and Yahoo. They wasted pretty much no time expanding from their starting point of San Francisco, going to new markets including LA, San Diego, Chicago, and Seattle. Their excess of cash was used to place an order for $1 billion for state-of-the-art warehouses that cost them $35 million apiece. The cash kept going out, but not a lot of revenue came in. The pressure from the venture capitalists to grow too big too quickly was probably one of the main reasons for Webvan's downfall. To give you an idea, they had a plan to launch in 26 new markets in 24 months, building a $35 million warehouse in each of them. They bought fleets of delivery vehicles similar to UPS trucks to deliver their groceries and even started buying out some of their competitors. And all of this before really figuring out how to make the business model profitable and successful in just one city. .com companies were in the mindset that if they build something, customers are going to come in droves, and well, they didn't. Looking at the difference between Webvan and companies that are around today like Instacart and Postmates, there's really two main distinctions. One, Webvan built their own infrastructure, which caused them to burn through their funding fast. Their warehouses were considered among the best of the best and had a ton of automation for the late 1990s. Within them, they also housed the food that people were ordering, which added a lot more expenses and logistics to the equation. Because companies like Instacart primarily operate off the infrastructure of existing grocery stores, they don't have the need to build expensive warehouses because their shoppers can go into the nearest Walmart to buy the customer's order. They also don't require you to place your order 2 to 3 days ahead of time, requiring you to be home in your 30-minute window. When I was sick back in August, I downloaded Instacart and ordered my groceries and had them delivered to my front door within 2.5 hours. That's insane. In late 1999, Webvan went public and they raised another $375 million, even though they only reported $5 million in revenue. And even with that, the stock doubled in the first day of trading, valuing the company at nearly $6 billion. Now I want you to pause the video right now and guess in the comments what the company was trading for just a year and a half later. All right, answers locked in. 6 cents per share. Webvan had pretty much outlived their cash reserves, shut down operations in several markets, and even warned people that they needed another $25 million if they wanted to continue operating. And with that, the board of directors voted to shut down the company in mid-2001. However, not everyone from Webvan stopped making money. Their short-lived CEO, George Shaheen, left his job as CEO of Anderson Consulting, where he was earning $4 million a year, to join Webvan. He signed a deal with Webvan that he would earn 50% of his salary for the rest of his life, equaling out to be $375,000 a year forever, which he still continues to collect today. Now, it's easy for me to sit here 20 years later and place the blame on Webvan for trying to expand too quickly. But that's not quite fair. All in all, Webvan's now looked at as the poster child of overfunding and overconfidence in the .com era. Louis Borders was not defeated though. He came back in 2020 and is trying to tackle grocery delivery with his new company, Home Delivery Service.